if you're very tired and you stay up all night and you just kind of force yourself through it, eventually you almost get like another burst of being awake again. All right. That's kind of what we saw in markets where they got so tight on the fiscal side and the monetary side that we kind of went past the looking glass towards actually being somewhat stimulatory because a lot of the private sector debt is low and fixed rate, especially in the household sector and in the investment grade corporate sector. So those industries have held up pretty well, whereas a lot of the U.S. federal debt is short term.
Soaring U.S. government debt is reaching a point where it will begin creating larger problems, Bridgewater Associates founder Ray Dalio said. The hedge fund titan warned during a CNBC appearance that the need to borrow more and more to cover deficits will exacerbate the political and social problems the country is facing. The U.S. is $33.8 trillion in debt, a total that exploded by 45% since the COVID pandemic in early 2020, according to Treasury Department data. Of that total, $26.7 trillion is owed by the public. Last year, the government rang up a $1.7 trillion deficit as it sought to keep up the pace of spending. As the debt built up and the Federal Reserve raised interest rates to try to tamp down inflation, the government spent $659 billion on net interest costs in fiscal 2023 to finance the debt. Dalio said that is a recipe for trouble, and Lyn Alden agrees with him. According to Alden, over time, business cycles accumulate instabilities, particularly in public debt. The past 40 years have seen rising debt, with lower interest rates and higher debt levels relative to GDP. Let us now get into the video as Lyn Alden dives deeper into the instabilities in the financial system, especially as a result of rising public debt. As you watch, remember to like, subscribe, and drop your comments below.
You go through a number of normal business cycles, but you build up instability in the system a couple different ways, including on the public debt side. And so if we characterize the past 40 years, we had ever rising public debt. So whenever we had a recession, we would have interest rates get cut. That allows higher debt levels, and you get lower lows and lower highs in interest rates, and higher highs and higher lows in both private sector and public sector debts as a percentage of GDP. And that coincided with basically the peace dividend, the opening up of the world. China opened up to the world in the 1980s. Soviet Union fell in the early 90s. And so we kind of entered this more connected world for a period of time. And we basically brought Western capital together with Eastern labor and resources. And that was a very kind of productive disinflationary time. Some people were hurt by it, but a lot of people were helped by it. And that's kind of been the era we've been in. And that allowed for lower interest rates. And when you look at the government expenditure, if you have higher and higher debt to GDP, but lower and lower interest rates, your overall interest expense remains manageable. And when we had the global financial crisis, a lot of things changed there. We had a bank recapitalization. We hit the peak in terms of private debt relative to GDP, but we pushed a lot of that debt onto the public sector in multiple countries, especially the United States. And so when we look back at prior long-term debt cycles, they do tend to come in a one-two punch. First, you have the private debt bubble kind of break apart, which is disinflationary. But then the second stage is when all that gets pushed up to the public sector, and then that becomes more of an inflationary type of crisis. So kind of ever since the past, call it 3-4 years, we've been in that second phase of the bubble. And so I think that's one of the best ways to look at it from a historical lens. But then, of course, you have to think, okay, what is different now in terms of culture, in terms of technology, in terms of just the way the world looks? What is different, even though that's a useful baseline. And it's, these types of periods are always weird. And so there's going to be challenging things to navigate that you didn't necessarily expect, which is why it's useful to have a framework, but to also be very flexible with your thinking to see what sort of curveballs might or may not come, and then, adjust that over time based on what's happening. Back in early 2022, when it became clear that the Fed was going to be quite hawkish, that was, my expectation was we'd have a recession by kind of later in the year. And that it'd be tough to get interest rates over 3% before you'd have kind of those types of problems. And for the most of 2022, that was correct. We had slowing economic indicators. We had 2 quarters of negative real GDP growth, even though they weren't technically a recession because they didn't have like an unemployment spike and stuff, but we had a period of softness. Asset prices had a pretty bad time across the board. And But then by early 2023, I started to see signs that it was playing out differently. That basically the fiscal deficits, ironically from part of that the monetary tightening, so the higher interest expense from the federal deficits, were starting to actually kind of balance themselves out. They were becoming kind of inflationary and stimulatory. And then when you had the kind of the mini banking crisis and the Fed's willingness to re-inject some liquidity in there to stop contagion, these things really kind of added up to a shift in how I viewed things. So it was, that's an example of being flexible, where you have a view, it starts playing out, but then after a certain point, it kind of starts being a little different. It's almost like if you're very tired and you stay up all night and you just kind of force yourself through it, eventually you almost get like another burst of being awake again. All right. That's kind of what we saw in markets where they got so tight on the fiscal side and the monetary side that we kind of went past the looking glass towards actually being somewhat stimulatory, because a lot of the private sector debt is low and fixed rate, especially in the household sector and in the investment grade corporate sector. So those industries have held up pretty well, whereas a lot of the U.S. federal debt is short term, and so that's been refinanced at much higher rates. And so the we have like two very powerful competing forces here. One is that the interest rates are putting downward pressure on a number of interest rate sensitive industries, commercial real estate and small businesses and junk rated companies and the like. But on the other hand, that interest expense is just completely blowing out the deficit, which is on its own, it's a stimulatory inflationary force. And in the past year or so, they've been roughly balanced.
Along with the basic budget issues, Dalio also cautioned that foreign buyers, who make up about 40% of demand for U.S. treasuries, have been backing off, creating a supply-demand problem. Data through January indicates that foreign holdings of U.S. government debt totaled $7.4 trillion, down $253 billion, or 3.3% over the past year. China in particular has cut its holdings strongly, pulling back 17% during the period. While not predicting a major crash, Alden expects a range-bound market with potentially significant fluctuations but not great real returns. She further points out that the Fed is always in a position to print more money, so it is not easy for things to rapidly go haywire. Let us now continue with the video as Alden explains further.
A country that controls its own unit of account is when push comes to shove, they print. And I'd be careful. That doesn't mean fully risk on, because, for example, the Fed right now under Jerome Powell, his legacy is on the line. He is serious about tightening. Um, and it's one of those things where he doesn't, if the stock market drops 20%, he's not going to care. If credit markets have problems, if there's a big cycle of commercial real estate bankruptcy, he's not going to care. If anything, they're good. That's like things he'd probably like to see. The markets where they jump in quickly are bank contagion, anything adjacent to that, like repo spikes, like they did in 2019, or the treasury market itself, right? Those are the cores of the system that that they're very unlikely to let struggle for long periods of time. Whereas almost anything else, you do have to be quite careful of. And that's part of why I don't expect, and for a while I have not expected, good stock or broad real estate returns, especially on a real basis. When you're comparing that to CPI, or when you're comparing that to what you can get on a T-bill, and things like that, the overall risk of those markets remains pretty high. But another way of looking at it is, you mentioned 2.9 trillion in debt. But it's like we have 1.7 trillion in annual fiscal deficits, right? It's like there's a fire hose of deficits going into the market. So you can have trillion-dollar bankruptcies that are kind of offset by trillion-dollar just ongoing fiscal injections. And so even if the Fed doesn't come to the rescue there, it's just that one industry is suffering, arguably right sizing. I mean, commercial real estate does have to go through a repurposing and just a change, because we've changed, our technology's changed, our locations have changed. But on the other hand, I don't think you're going to see like restaurant sales go bust, because the people that go to restaurants, a lot of them are on the receiving side of these very large fiscal deficits. And so it's a very kind of industry by industry market. And I think the overall aggregate is kind of stagflationary range bound type of thing, where it's some people feel like, what recession? I don't see a recession. And other people are racking up credit card debt to get by, because for them it already is a recession. And it's just very industry specific, individual specific, and the overall range is that kind of murky sideways action. fact that we had like a 20% drawdown and then a partial retrace, and then we're having like another drawdown now, that's to be expected. I mean, you could have a 10, 20% move with not much of a problem, especially over a multi-month period or over the course of a year. I think a useful model is to look at emerging markets when they go through recessions or just in general when they're kind of in a malaise. Often the stock market's not going down big in nominal currency terms. It's doing bad in dollar terms,
Yeah.
but it's usually doing fine in nominal local currency terms. And I think that basically when developed countries go through sovereign debt crises or things like we're having now, it's basically like a developed market with emerging market characteristics. And
Yep.
so either look, I use the 1940s analog a lot, but potentially more accessible analog for people is just look at emerging markets. I'm not saying the absolute basket case ones, but just like the standard quintessential emerging market, what do their recessions look like? What do their stock markets do in nominal terms versus, say, compared to dollars or gold or whatever? And I think that there's some comparisons there that are instructive. So I would expect a range bound, and that range could be pretty big, and then not great real returns. Probably, we've had negative real returns since, like early 2021 or like mid 2021. Um, and I would expect that to continue for a number of years, because I think that some of the more defensive assets, like literally, T-bills, tips, that at their positive real rates are interesting now. I prefer gold and Bitcoin. I think there's some emerging markets that are attractive if you choose them selectively. There are a mix of assets out there that are interesting, but I think the ones that have been expensive and crowded into, are just unlikely to do good returns. And that, things can correct in price or they can correct in time. They can just be in a range for a long time, and that is eventually a correction.
Shoppers kicked off the holiday season with a bang as a record 200.4 million people hit stores and search websites for gifts from Thanksgiving Day through Cyber Monday, according to a survey by the National Retail Federation. The turnout marks an all-time high since the major trade group Prosper Insights and Analytics began tracking total in-store and online traffic in 2017. It topped last year's figure of 196.7 million shoppers and the NRS forecast for about 182 million people during the five-day weekend. The number of people shopping online rose to 134.2 million this year, up from 130.2 million a year ago, the NRF survey found. Consumers who shop at stores fell slightly, from 122.7 million people in 2022 to 121.4 million people this year. The major trade group did not estimate total spending but said shoppers shelled out an average of $321.41 on holiday-related purchases over the weekend. That's roughly in line with the $325.44 average last year. The number is not adjusted for inflation. Another early read on holiday spending showed strength in online sales. On Black Friday, consumers spent $9.8 billion in U.S. online sales, according to ADA, up 7.5% from a year ago. Cyber Monday topped that as e-commerce spending in the U.S. totaled $12.4 billion, up 9.6% year over year. Yet, it is too soon to predict how the rest of the peak retail season may play out. Strength in early shopping could reflect shoppers' hunger for good deals rather than their desire to spend. It could also show a reversion to a pre-pandemic pattern of holiday shopping when customers concentrated their spending during peak times like Black Friday sales events and the final days before Christmas. Retailers struck a cautious note about the season when reporting earnings earlier this month. Some companies, including Walmart, say discretionary spending remains weak, but has picked up during promotional events. Holiday sales in November and December are expected to rise by 3% to 4% year over year to between $957.3 billion and $966.6 billion, according to the NRF. That's slower growth than during a pandemic, but roughly in line with average sales increases before COVID. Do you think aggressive consumer spending could influence the Federal Reserve's interest rate hike path? Let us know your thoughts in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.